Hi, everybody, and thank you for joining us for today's construction insurance market update. Thank you to the Chicagoland AGC for partnering with us and letting us present today to all of you. I have with me Kristen Long, who's our regional managing director of our construction practice here at Gallagher. I'm Kelly Hogan. I work on her team, and we do everything from insurance placement to contract review, safety management, really kind of anything under the sun when it comes to construction risk management. And so today we're going to give you an insurance market update on what we've been seeing with our clients and what we anticipate to continue to see into 2021. So as we go to the first slide here, I'm just going to give a really general overview of what we're seeing from a pricing perspective. So overall, we're in a hardening market. And what that means is increased pricing and decreased capacity. We'll go through in more detail line by line, but just from a pricing perspective here, as you can see, property, we're seeing 15 to 40% increases. Umbrella excess supported, we're seeing 20 to 60% increases, and unsupported 30 to 100%. So just to kind of clarify that, supported is if the excess carrier also places the primary insurance lines, and unsupported is if the excess carrier does not provide your primary lines and only is on one of your excess layers. So as you can see, the unsupported is seeing even higher increases, which shouldn't really be very surprising. General liability, we're seeing either flat to a 20% increase. So this is one of the more recent lines to start hardening. In the last few years, this has been relatively flat, but we are starting to see some increases coming up on that line as well. Commercial auto, kind of the opposite. This has probably been the line that's been hardening the longest. Probably no one's surprised to see here about a 5 to 12% increase. It's starting to stabilize a little bit, but we're still seeing regular increases on most commercial auto policies. Work comp, this is another one that has been historically stable over the last 5 to 10 years. But for the first time now, we're starting to see some increases in premium and in rate with our construction clients. So hopefully that doesn't get too crazy. We don't know really what the effects are going to be based on this last year with COVID-19, but we're hoping that it'll plateau out at 5%, but we are starting to see this line harden as well. And then cyber as well, 15 to 50% increases we're seeing on this. Again, I don't think anyone's probably surprised to see these numbers just based on the increase in frequency and severity of cyber claims that we've seen recently, especially with COVID-19, people working from home, increased risk, and less cybersecurity that's going on. So the bottom line here is the insurer that holds the key to the excess will be the best market for your company. And Kristen, if you could comment a little bit more in depth on that, that would be great.
Sure. Thanks, Kelly. Hello, everybody, and thanks for listening to our call today. The reason why we feel that the insurer that holds the key to the excess will be the best market for your company is because right now, with what we're seeing in the marketplace and with the excess driving the majority of the cost, there might be only one winning combination between your carrier, your excess carrier, your work comp carrier, your auto carrier. There might be just one winning combination for your company. And if you buy a higher level of excess, like 25 million, 50 million, or 100 million, placing those together, there might be only one carrier that fits into each one of those slots to get you all the way up to 100 million. So the statement that Kelly's talking about, it's really best served if you pick your insurance broker or agent first, and then let that broker or agent go to the entire marketplace. With the fact that the excess is driving it, if you have multiple agents competing against each other, they could essentially block themselves out of the market, which could leave you paying more money for your insurance because we could have missed a carrier that maybe somebody just couldn't get to. Did that answer the question, Cal?
Yep, perfect. Thank you.
All righty. So just wanted to go over some of the compounding factors as to what's driving the market. You've all seen all this. I don't want to talk about all of this. So I'm going to move to the next slide and just give you my opinion about what I'm seeing really go on versus all the compounding factors that are in the news and everything that you're hearing everywhere else. So behind the scenes, what you should want to know about what's going on. If you think about it, insurers started to feel pressure back in 2018 with increased demands and jury settlements, and their first reaction was to go ahead and try and increase premium to try and slow down the amount of insurance that people were buying. So back in 2018, rate increases started on the excess line at about 3 to 5%. And on this entire slide, I'm pretty much going to just be talking about umbrella and excess insurance. So 2018 rates go up 3 to 5%. This continues into 2019, and by Q2, the rates were up between 5 and 10%. On the flip side, the insureds continued to buy the same amount of insurance even as the premium increased. So the carriers really didn't shrink the amount of insurance that people were buying and the amount of insurance that was available for demands in large jury settlements. So by Q4 of 2019, that 5 to 10% increase turned into 30 to 50%. And quite honestly, it happened almost overnight. By Q1 of 2020, the market began to reduce capacity. We saw standard carriers pulling out of the marketplace and leaving it so that it literally happened overnight. Carriers, instead of providing us with $25 million lead umbrellas, they went to providing us $10 million lead umbrellas. Now, remember, this is Q1 2020. So this is right at the beginning, right when COVID started. By Q2, the surplus lines markets became inundated with new business submissions because the standard market carriers were only providing 10 million versus the 25 million that they had been providing. Surplus lines carriers then began reacting by shrinking their capacity to 5 or 10 million on each layer, no matter how high the tower went, versus the 25 million they were providing. In addition to shrinking capacity, they started to add exclusions. And I put this in bold letters and I say it twice and then I say beware of exclusions. And I'm going to go through this because the exclusions that are being added are falling in at a lot of different places within your tower. They might be on your leads, but the coverage exclusions are extensive, and you need to be aware on any surplus lines placement as to what's really sitting in those policies. And most of them are designed to reduce coverage for construction defect claims that are latent, that become completed operations claims. In addition to shrinking capacity and changing coverage, the surplus lines carriers and even the standard market carriers are squeezing the general liability carrier and auto carriers by forcing them to take on higher underlying limits. The rate increases are real that you're seeing, and you should be prepared. Everyone is feeling the pain. And if you've had a claim in your excess layers, you're probably going to be impacted more than someone who doesn't have a claim in their excess layers. So moving on, I want to talk about profitability by line of coverage. And it's all about control. So in interviewing multiple different carriers in preparation to have this call with you today, I started just talking to them about the lines of coverage that are the most profitable for them and really why. So workers' compensation is the most profitable line of insurance for insurance carriers. They feel that the control is in the hands of the insured. You're pressured to keep control of your experience mod, and also that pressures contractors to manage their claims. You have the ability to return people to work, help manage their medical care. You have immediate notification of claims. And also you have the ability to train people. So it makes sense as to why workers' compensation ultimately is the most profitable line of insurance for the insurance carriers, because you as the insured have the most control. The next line of coverage where you have control is property. Carriers make recommendations. Owners want their buildings to be working properly and well maintained. The problem where we see issues on property are all out of the control of our clients. It's all weather related incidents that really are not controllable. The one nice thing about property for the carriers is that losses are immediate and insurers can plan to pay claims quickly and immediately so they can budget for where those losses are going to be. Now we start getting into the middle of the pile here with general liability and auto liability. I'm going to start with the general liability. There's somewhat control, but with some contractors lose control based on what their subcontractors might do. Claims are often latent, often come in 2 to 15 years after completion of the project. And in some states, the statutes of repose even allow, if bodily injury is involved, the statute to be unlimited. There's no control over BI claims, meaning you don't control the medical, you don't control returning people back to work, and you're often surprised by these claims because 2 years after the incident, right when the statute of repose is going to run out, you receive a lawsuit. Construction defect claims are also unknown until the occurrence takes place. So there could be a water damage claim that is ensuing that started 2 or 3 years ago that might not be brought to your attention until the owner brings it to your attention down the road. So these are things that you don't have control of, and also the carriers don't have control of. So that's really why general liability is not more profitable to an insurance carrier than property. The auto liability, it even goes down even further. The control that you have is training your drivers and maintaining the vehicle maintenance on your cars. You don't have control how other people drive, and you certainly don't have control of the claims. Auto accidents, most of the time, if there's injury, you certainly don't hear for those until the 2-year statute of repose is about to run. So with no ability to manage BI claims or even plan for the cost, that's why auto liability has been a problem and continues to be a problem for the carriers. And then when you get down to the bottom on the excess, if you combine what happens on the auto and the general liability, it just echoes that again onto the excess liability. So when it comes down to profitability for carriers, it is really truly all about the control. I want to just show you here an example of what's going on with capacity. So when we build excess towers in 2018, we would buy your primary insurance at $1 or $2 million, or maybe $2 and $4 million, depending on what state you're performing work in and what the requirements are. And then we would build an insurance tower up to 100 million by placing 4 carriers that offered us $25 million policies. We would place them on top of each other, and you would have a $100 million tower. During that time, we had over 20 plus carriers that were willing to participate in these towers. Capacity was almost literally unlimited. We could easily get 200 million, 300 million, and $500 million towers for larger contractors. Standard market options were available and competitive pricing existed. If you look at what happened, when I say literally overnight, fourth quarter 2019, this is what on the right there, what our umbrella tower now looks like to get to 100 million. You can see where the primary insurer was forced to take on the 2-4, and then you'll see where chunks were bought at 5 million. You'll see how it's on that second line, it shows 555 across. That's because it took 3 carriers on a combined quota share policy to get to 15 million. So instead of having 4 insurers in this particular tower, it took us 12 insurers. We had coverage restrictions. We had limited capacity, as you can see with the 5 million and the 10 million. Premiums were significantly higher. All of these were surplus lines placements. And some of the carriers even wanted this stuff to be auditable. This is an example of something that just happened here just a few weeks ago. This is a live example of a client that has $100 million tower. And you can see where we've got chunks of 10 and then a couple 5s in there all the way on the left of this screen. And then you'll see where I notate wildfire coverage, excess wrap coverage per project aggregate. So you'll see in this particular tower, we were able to get wildfire coverage all the way up to 100 million, which was quite shocking to us, because that is the coverage that everybody wants to push away from because of the catastrophic nature of wildfire. But if you look and you can see where carriers are really starting to pull back, excess wrap coverage and per project aggregates. Excess wrap coverage is real, and it falls into something that's being targeted now by insurers, because underlying policies and excess towers can sit on top of any OSIPs or CSIPs that you participate in. This is a real exposure to your programs, and you can see that by what the markets are doing and where they're limiting capacity. On this particular umbrella tower, they limited capacity to on per project aggregates. So just wanted to show you where we're seeing how the tower is shaked out, and what we're seeing coverage being limited in $100 million tower.
Kristen, I want to take a pause really quick. We're obviously talking about larger contractors and someone that might have $100 million tower, but there might be contractors on the call who don't have $100 million tower, either middle size or smaller contractors or even subcontractors. Can you comment on, how having to stack those layers like that, the decreased capacity and increased costs are affecting those contractors with the large generals having to deal with this?
Sure. So there's really a butterfly effect off of what's going on with the larger contractors. So what's really happened to the smaller contractors is that they were able to buy in the marketplace. They're able to buy umbrella policies that had minimum premiums that used to be set at $5,000 minimum premiums. Now those minimum premiums are up to $25,000. And in some cases, some carriers are even upping minimum premiums to $100,000. Now, I'm not trying to scare any of the smaller contractors on the phone. There are still plenty of carriers that are writing smaller contractor umbrella policies, and those would be your regional carriers. But in the surplus lines marketplace, we are definitely seeing that minimum premium. For sure, smaller contractors are feeling the pain on coverages. And we're also seeing a lot of carriers less interested in writing contractors, which I'm going to talk about on this next slide. And the last thing is that there's more downstream push because of the shrinking capacity, more downstream push to those smaller contractors via contracts.
Great, thank you.
General market conditions, construction specific. So we're seeing the excess market, we're seeing the carriers in the excess marketplace pull out from street and road, residential in certain states. So if you're involved in any sort of street and road construction, I put look out, because I literally mean that. Look out, because your renewal is not going to be as easy as it was in the past, especially in the excess. If you're out in the surplus lines marketplace at all buying your umbrella or excess coverage, it's going to be more difficult this year. And I suggest you start at least 120 days out. On the residential side, shrinking capacity daily with wicked exclusions. There's literally only certain markets right now that are willing to write residential, and we're seeing new residential definitions and descriptions in all policies, regional and national carriers. So be careful. If you're a residential company, chances are you don't have these, but if you're a commercial contractor that does a small amount of residential, really scour through that information, because we're finding it all the time. Certain states, New York, California, and Colorado, and I would say all wildfire areas, we're seeing a lot of exclusions. Specific increases in attachment points are required. So on an earlier slide, I said that the excess marketplace was squeezing the general liability marketplace. And this is what I meant by it. So instead of having 1 million occurrence and 2 million aggregate on general liability, they're requiring that the GL carrier provide 2.4. Some of you, most of you are already doing this because you're in Chicago, and Illinois is a horizontal exhaustion state. So the generals require this, but it's just what I'm talking about here is what's happening to the insurance carriers and why we feel that there's going to be GL increases in premium because they're taking on these different layers. Auto fleets over 100, we're seeing requests that, those attachment points on the underlying be 5 million versus the 1 million most of you currently have. New York, we're seeing attachment points up to 10 million. Most incumbents are retaining and maintaining their business at higher price points. Most placements, even with minimal adverse loss history, are still marketing or restructuring their programs with excess and surplus lines markets. And my question is do you have relationships there? Because you need them. New terms and conditions and restrictions, again, exclusions beware, and national carriers versus regional carriers. Your regional carriers are more structured for the smaller contractors. The national carriers are more structured for the larger contractors that do work, maybe not necessarily in one state or one region. So I would highly recommend that the smaller contractors try and focus on regional carriers at this point as their carrier partners.
Kristen, you talk about increased attachment points. So, 2-4 instead of 1-2. Are you seeing that having a positive impact on excess pricing since there's more limit before you hit those excess layers? Like, are they building up credit somewhere else for those increased limits?
Yeah, they used to. So back in 2018, if I increased the primary to 2-4, then I would get a reduction on the excess layer because that first million that they would have paid is literally not their exposure anymore because it's on the primary. And we're just not seeing that. There is no reduction at this point. They're saying, yeah, thank you. That's our requirement. Here's our price. Anything else?
Gotcha. Nope. Go right ahead.
Wanted to just start to go through slides here concerning just each line. So the general liability market, and this is construction specific, general liability, carriers, like I said, are being squeezed by the excess market. It's happening internally at insurance companies too. One department is passing exposure to another department just to make sure it doesn't hit their P&L. What I'm worried about is that the primary limits that were 1-2 are now 2 mil, and the auto is up from 1 million to 5 million. And those are active layers where there were losses. I mean, the excess and umbrella marketplace didn't start increasing premiums because there weren't losses there. There are legitimate losses, and especially in these lines that they're internally, departmentally passing on to the GL and even the surplus lines to the GL carriers. So this is going to have an impact on GL rates. And we think that's why general liability rates are going up already. Another thing that is concerning is that the increase in primary attachment points does have an impact on horizontal exhaustion of limits. Larger contractors that are forced to increase primary attachment points in states like Illinois that follow horizontal exhaustion of limits, technically you open yourself up for more exposure via just the way claims are paid in Illinois. So something to keep in the back of your mind as you take on those higher attachment points. Increase of using exclusions and non-standard policy forms. Regional carriers and surplus lines carriers. Coverage that was purchased during the course of construction is changing during the completed ops period. So I'm a little worried that contractors that bought policies in 2017, 18, 19, did projects. Now those policies those construction projects are entering that completed ops phase. And I'm very concerned that the coverage is changing because the subcontractors are buying something different. So there might be exclusions in those policies that general contractors and owners and subcontractors aren't aware of, and latent claims that get turned in that one would think they might have coverage for might not. So this is just kind of a warning. Hey, check your policies, take a look at your work that you've done in the past, and remember that you have 10 years that you're responsible for completed ops coverage. So really think about that and pay attention to that as you purchase your insurance this year. Property damage as an occurrence is most contractors do not understand the impact of this or how it impacts coverage in certain states. And we're seeing this not defined in policies, and that is a huge problem. Excess wrap coverage, like I mentioned, this is a critical coverage that everybody should be paying attention to. And I'm just not sure that everybody's going to still be receiving that. As I talked about on the slide before, you can see where coverage is being limited.
Kristen, one thing, one question I had is if, you talk about changing coverages for subcontractors and how that could become an issue with completed operations over the statute of repose. If you have a well-structured controlled insurance program or SIP, does that kind of help protect contractors from that a little bit?
If it's a well-structured SIP, yes, but some contractors and subcontractors have better insurance themselves than what are being placed in some of these SIPs. I've seen SIPs that only have $25 million in limits, and I have clients that have 50 or $150 million or $200 million. So if they participate in that SIP, they would have less coverage. I've seen some SIPs that might have exclusions that they wouldn't have in their policy. So these excess wrap exclusions and excess wrap coverage that I'm talking about, that I'm saying is critical, provides a difference in coverage to them in case the wrap up, when I say wrap up, I mean OSIP, CSIP, doesn't have coverage that they would have had in their policy. And there are a lot of carriers that provide that in their policies free of charge. And we're seeing them remove that coverage. So the example I showed you about in March, the one we just did, in years past, we had $100 million worth of excess wrap coverage, where now we only have 35 million. Did that answer your question?
Got it. Yep, thank you.
So I wanted to just quickly go through some of the exclusions we're seeing in the casualty market today and what you should be concerned about and what you should be looking for. So again, that excess wrap-up exclusion, we want to make sure that your policies have coverage for difference in coverage over a wrap-up. We're also seeing progressive and continuous injury and property damage exclusions. These are aimed to exclude completed operations. We're seeing per project aggregates being limited, meaning that limits are becoming more singular. And all of you know that every contract you sign requires a per project aggregate. And we're seeing in the excess marketplace a lot of exclusions on that. We're also seeing subcontractor warranties, meaning if a contractor has a policy with a subcontractor warranty, and this even goes for subcontractors who hire subcontractors, that warranty means that you're responsible for making sure that that subcontractor has certain insurance. Some of those subcontractor warranties state that if they don't carry that insurance, you'll be charged. Some of those state that if they don't carry that, then there's 100% no coverage. So very tricky, needs to be paid attention to. Non-accumulation of limits. That means that if one occurrence were to take place during multiple policy periods, we're seeing the carriers say, sorry, we're only going to give you one set of limits, even though you've paid for multiple sets of limits. Punitive damage, uninsured, and underinsured motorists, communicable disease exclusions related to COVID-19, EIFS exclusions. These exclusions can be tricky because some of them have language that say if EIFS is on any part of the building, even if the insured did not perform the work, if it's just on any part of the building, no coverage. And then again, wildfire exclusions and state exclusions. So these aren't all of them, but these are the biggest ones that I've been seeing over the course of the last year and popping up on policies that I would never imagine.
Can you comment on like how often you're seeing these? I mean, I think people
Every
think this is
time.
once in a while. Yeah.
No, I'm telling you that I'm receiving quotes, and every time I receive a quote, I have to go back and negotiate with the carrier to get these wicked exclusions off. And I say wicked because they're wicked.
Gotcha.
How to best manage your casualty. Again, devil's in the details. I can't emphasize this enough. Believe that your rates are going to increase. Plan for it ahead of time. I spent a year trying to explain to people that the excess marketplace was going to go up. And I started this like mid 2019. And I had many conversations with people, shared the exact percentages that we knew it was going to go up. And then when we delivered the renewals, everybody was shocked. And if you leave this call with one thing today, please understand that this is happening to everybody. Included in your bid rates. It's going to happen. I apologize for it, but it is going to happen. I will say the next thing is that relationships really matter, not just on your primary insurance, they matter all the way up. So I would say that, you should evaluate the relationship that you have between you and your primary underwriter, rated on a scale of 10. If it's 10 being the highest, if you feel that relationship is at a 4, try and get that relationship to a 5, 6, or 7 this year, and keep continuing to work that relationship up to a 10. If you don't have a relationship with your excess carrier, you got to make sure you start to get that relationship going. I would also ask you to quiz your broker what their real relationship is, because that really solidifies like a perfect triangle. How well the client gets along with the underwriter, how well the client gets along with the broker, and how well the broker gets along with that underwriter as well. All of that is extremely important right now, because you tell your story. You tell the story best why you're best in class. If you've had losses, you're the best person to talk through how that has been managed. We need to put our clients back in front of the carriers to talk about how they're managing, or how they have managed claims in the past, how they're managing protocols, new protocols that were put in place because of claims, how your QC program is, if you've had any auto losses, what the training is. Very important that you're the one telling that story. Also partner with construction experts versus generalists when it comes to advising you on insurance. And I don't just mean that when I'm talking about brokers. I mean that when I'm talking about carriers. You want an insurer that does not dabble. Every time we get involved with a client that we might take over that was with a carrier that dabbled in construction, most of the time that leads to a dispute between the carrier and that client over policy language, because the carrier just didn't have the necessary construction language that was needed. Pay close attention to your exclusions, read your policy, and as I said earlier, increase your rates as soon as possible so that you're not caught bidding jobs today and paying for the insurance later when your insurance goes up and you're working on those jobs.
Yeah, Kristen, you say as soon as possible. Can you give some insight on how early you typically know these increases are coming?
So I would say I know every day, because every day we're in the market on another account, right? So every day I'm in the insurance marketplace and I know what to expect. But when it comes down to an individual account, I would say that reasonably 6 months out, you should be able to get a solid, some sort of solid number as to what the carrier is thinking about your renewal. Should things remain the same, if something happened between 6 months and 3 months prior to renewal, and there was a really bad loss that came in, or a loss really got out of hand, I would tell you that those numbers might change, but I would tell you we're getting solid indications 6 months out. Moving on to property, I wanted to be specific to builder's risk today, because one of the biggest issues we're facing right now with builder's risk is the extension for delayed projects. We're seeing carriers change terms and conditions, increase rates, or flat out just not allow an extension under the current policy. We're seeing sometimes projects that are almost finished and all the dollars are collected. If those carriers decide that they don't want to extend that policy, this is not attractive to a new carrier. So it's very important that if you know you're going to have a delay on your project and you had a builder's risk policy, that you have that conversation immediately and talk that through with the carrier so you can figure out what you're going to do. I literally just had a situation on a frame policy on a university where there was 3 months to go on the project and the carriers refused to extend 3 months. Remember, it was frame. It was $100 million project. And the market wanted $1.3 million to insure that property for the 3 months. Now, we ended up doing something crazy and we ended up going to the marketplace, buying coverage without fire for $100,000 because our client was more worried about water damage than fire damage. So we ended up helping them that way. But that's just an example of what we're seeing out there that I wanted to share. Rates are increasing and coverage enhancements are becoming more costly or not available in the market. Frame capacity continues to be difficult, but on a positive note, we've made some headway on mass timber in the standard market. Communicable disease, COVID-19 exclusions everywhere. Leg 3 still available, but with increased deductibles. Water damage claims continue to lead the pack. Do you have a strong water mitigation program? And I say that because those contractors that have the strongest water mitigation program are going to get the best rates in builder's risk, period. There's some recommendations there at the bottom that I've already gone through on the project delays.
Kristen, are you seeing, sorry, real quick, are you seeing any difference in this on if the owner versus if the contractor is placing the builder's risk?
No.
Okay.
Auto liability, the line of coverage that started the hardening market. I think you started the conversation, Kelly, by saying that. So in 2016, we started seeing automobile rates climb. And that was the first big rate increase since 2003. So 13 years. A factor causing the increased premium is the continued reduction of reinsurance capacity. So again, here's the attachment points: 50 autos, 2 million, 100, 2 to 5 million, and over 500, 5 to 10 million. Also, one thing to pay attention to is the Department of Transportation has those CSA scores, and those do matter. So, you know, the underwriters do check those scores and they can see violations under your company for anything that you were cited for with your vehicles. Companies are also increasingly eliminating their company car programs and going to car allowances. This is to remove their liability exposure. However, the non-owned exposure is still real, but it's removing a lot of that. One thing to pay attention to while you do this is that you do need to make sure that you have a system in place to make sure that you're reviewing the personal lines policies of your employees so that they don't have exclusions for business use. Because as I said, that non-owned exposure is real. And if there's exclusions that lie within the personal lines policies, you could end up in the same place. So we highly recommend that you find a way to make sure that you're actually reading the entire personal lines policy versus just looking at an ID card to make sure somebody has coverage. Also, it's very important to keep up to date on your implementation of hiring practices, because that is something that carriers are looking for. Kelly, I'm going to flip it back to you because this is a big passion of yours.
Thank you. Yeah. So, I mean, Kristen talked about having all your controls in place and that underwriters are really paying attention to what individual accounts are doing. So we put this together because, you know, obviously a lot of our clients struggle with this, and these are kind of the tools that we've identified that best position them in the market and actually have the realest and best results for them when it comes to their auto claims. So first and foremost is collision avoidance system. So these are actually like cameras in the car, you know, auto alerts and those kind of things to avoid collisions. So a lot of our clients utilize Mobileye. They're a great partner of a lot of our clients. And again, underwriters are asking these kind of questions, you know, like what technologies are you utilizing to help in your fleet safety? Another big one is cell phone blockers. So these actually go in the car and block people's cell phones from working. I mean, you can program it to, that you could still get calls or make emergency calls or whatever it is, but that you disable texting and, internet and whatever and data while they're driving. So this has had huge benefits for some of our clients. Truce Software is the name of the company that multiple of our clients utilize. Um, and then finally, I'll talk about MVR notices. So this is through a company called Samba Safety. And this is basically 24/7 notices on MVR. So if one of your drivers has a suspended license, if they get a DUI, if they get a traffic violation, you're automatically notified of this. So typically MVRs are being run about once a year. But what we're finding is, obviously incidents are happening in between those two checks. And it can cause quite a headache if you have a driver that's driving without a license and that you have no idea about. And a lot of times you wouldn't unless you have up-to-date MVRs. So those are just kind of three. There's obviously like training, telematics, dash cam. There's a lot of things to look into. But again, we're just reiterating the fact that underwriters want to hear about this stuff, and it's only going to help your case in the auto market at your renewal.
Thanks, Kelly. So on the workers' compensation, control does matter. So it's important that as you negotiate your workers' compensation, you talk about your controls. So insured controls, safety, hiring practices. So this is something that you really want to spell out to your carrier, especially as like Kelly mentioned at the beginning, we're starting to see some rate increases come through on the work comp. We are still seeing a lot of favorable work comp, but we are seeing rate increases come through on those accounts that are not performing well. You need to protect this line. So this is why I did want to include this slide, because the insurers told us that this is the line that they make the most money on. So if you've got a good performing line for your work comp, then we're sitting in a much better place when we talk to them about writing all of the other lines, especially the auto and the general liability. We believe that as the marketplace starts to turn more negative, that it's really important that like I said, that you stay positive over the course of the next few years to give yourself more leverage under your general liability. Wanted to just quickly bring up an interesting stat. A lot of people ask me all the time, what do I know about workers' comp and COVID claims? I'll tell you, and I put this in here, it really doesn't have anything to do with renewals, but there have been 674 COVID-19 claims reported as of January. Approximately 1.5 are severe cases involving ICU, and 8% of those are moderate. So of the cases, 73% of them were valued under 5,000, and 85% of all cases are valued under 10,000. So I know this has been a hot button that we've all been talking about. I've attended a lot of webinars on this, but good news is that we're just not seeing a lot of high valued claims coming out of the COVID. So how do you best position yourself for your renewal? Have a plan. Make sure that your agent or broker is a construction specialist. Make sure your insurer has a construction practice. Set expectations early. Kelly asked me the question, 6 months out. I know when you finish your renewal, you want to be done with it. And I'll tell you, we've spent all COVID going from renewals to working on your next renewal because the market's been kind of crazy. So I almost want to say, unfortunately, I think in 2021 and maybe into 2022, you're going to have to be thinking about your renewal all the time again, just because of where we're at in the marketplace. If you decide to go out to the market, pick who you want to represent you. Do a broker selection. Find out who knows the carriers. Find out who you really trust to go to the market for you versus just saying, okay, I'm going to bring 3 people in. You all go out to the market, figure out what carriers, and just bring me what you got. I'm not feeling that that's working right now because, like I said, I think there's really only 1 or maybe 2 perfect combinations of insurers to get you what you need. And you'd be better served by picking 1 professional to control that for you. Your submission is critical. I don't know how many of you've ever seen what your broker or agent has sent in. I challenge you to ask them. Take a look at it. Is it sloppy? What does it look like? Ask them to see it, because this is how you're being represented. That submission is how your policy is priced. I also think it's key to show the carrier what you've done to implement COVID-19 controls. It just shows that you're on top of things. I mean, I realize that there's not been what we thought there would be in work comp, but that also doesn't mean that the carriers are still concerned and they still want to make sure that you've got those controls in place. Again, I can't emphasize enough how important relationships are. And the last bullet there, which I didn't talk about, but except for the first slide that said that cyber insurance is going up. Cyber insurance is going up because the claims are unbelievable. I had 4 clients, smaller clients, over the course of the last year who I have proposed cyber insurance to for 10 years, not buy it. It was under $5,000 in premium, and 4 of them were impacted by ransomware attacks. So ransomware is crazy right now. And I will also tell you, social engineering claims where people are finagling ways to transfer and maneuver money all over the place is another thing. So thanks for your time. Kelly, did you have any questions or?
No, I was just going to add that ransomware attacks actually are up 113% in 2020. So incredible, crazy amount. But
I know there was a question on reinsurance.
Yeah, we have a couple of questions that came in with registration, actually. So one was on the reinsurance market and what you're seeing capacity, especially for large residential developments.
Sure. So residential really falls under 2 buckets. So you've got residential that's for sale, and you've got residential apartments. Historically, that's been defined in policies, and it was very easy for us to say, oh, okay, residential exclusion, but apartments weren't included. So right now we're seeing certain, and I wouldn't even say that's reinsurers, but we're seeing certain carriers define that differently. So I'm going to take a minute and just kind of talk through, we're seeing massive exclusions, massive push downs from reinsurers. That's really slimming down the market. So what the reinsurers have done is they've kind of said, okay, we'll let these carriers do reinsurance. We'll let these carriers do residential. We really want to push residential into project specific. So that's why you're seeing so many residential exclusions on the primary policies, because they really want to put residential into its own category. So project specific seems to be the best way to go with it. The most interesting piece to answer this question is that more to follow, because right now we're still operating on reinsurance treaties from July of 2020. The reinsurance treaties renew in July of 2021. So more information, we really need to watch this to see what the reinsurers are going to do in July. But to answer that, project specific, one other thing I wanted to talk about that reinsurers are doing is that they're forcing on residential for sale, not the apartments, defense cost inside the limits. What that means is that instead of defense being outside the limits, so if you have a $1 million occurrence limit or a $2 million occurrence limit, and you have a $2 million claim and a $500,000 spend on defense, the way your policy that you're accustomed to, defense is outside the limits, no problem. They pay the $2 million claim, they pay the $500,000 in excess. But when defense is inside the limits, that $500,000 gets paid inside those limits. So you only have 1.5 to pay the claim. So you're short $500,000 in essence. So that's something to really keep in mind, is that even on project specific, all of those we're seeing in 2021, defense is in the limits. So you need to pay attention, because some of you don't do residential all the time. You might have residential exclusions on your policy. So if you're involved in a project specific and they run out of limits because defense was inside the limits, this is what I was talking about before, about being very concerned about not having excess wrap coverage, where if the wrap up didn't have enough limits, you would be able to sit on top of it. So that's my residential reinsurance blurb.
Awesome. Thank you. We had another question with registration, and one also came in the chat, was around the captive market. The question was, captives were a hot topic a few years ago. Are they still a viable option, and what size and type of counts are you typically seeing going into captives?
So yes, captives are very viable market. But I just want people to understand that while captives are viable, they're very similar to how standard market loss sensitive programs work. So if you're in a standard market loss sensitive program, not sure that a group captive I'm talking about right now would be necessarily the right fit, because that's probably going to impact your cash flow a little bit. But those of you that are on the phone that are guaranteed cost buyers, group captives are a very viable option for you, as you take on some risk, but instead of your premium all going to the insurance company, some of your premium, about 60% of it, ends up going into a loss fund. So if you're a really good contractor that is buying guaranteed cost, now 60% of your premium could come back to you for not having losses. There is also an upside of that, but on somebody who's got really good experience, usually that risk is worth taking. Now, on the other side, larger accounts that are already loss sensitive, we're seeing an uptick as well on single parent captives, not 831B captives, full single parent captives for surety, for a lot of different things.
Gotcha. Thank you. And the final question that we had was, contractors are potentially liable for violations of Title III of the Americans with Disabilities Act. What insurance products are available to cover that risk?
So that would be your executive, your management liability, your EPLI. You probably need some D&O on there for decisions that were made. So that would be your executive lines. So really need to look into some EPLI coverage.
That's a whole nother webinar.
That's a whole nother webinar. This
All
one
right.
already ran over, so.
Well, that answers all the questions that we had. So thank you, Kristen, and thank you again to the CAGC for letting us host today. And if anybody has any additional questions or anything comes up after the fact, please feel free to reach out to Kristen or myself. There will be our contact info on the slides that are sent out. So everyone have a great day, and we'll talk to you soon. Thank you so much.